Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club, and today I want to talk about whether one stock can make and break your portfolio or even give an indication of what lies ahead for the economy or the stock market. I've seen this happen a lot in the financial media where they take one single stock, whether it's Apple or FedEx, and they try to convince you that it's a sign that means things are only going to get worse or they're only going to get better. And this is really a terrible way to run your portfolios, to isolate one stock. And I can give you a number of reasons. Let's just take FedEx as an example. Now, it seems on the face of it, if FedEx is doing poorly, well, then the economy must be bad because most products have to be shipped. And if they're not shipping through FedEx or UPS or one of the leading transportation companies, that must be a terrible thing for the economy. But if you dig a little bit deeper, you find that there are reasons why the shipment of packages, for instance, with FedEx, are down. For example, most people don't really want their groceries delivered by overnight mail or to be shipped at all like they did during the pandemic, especially before we had vaccines. And so that business is down. And there's a lot of people who bought a lot of stuff when they were stuck inside social distancing, but they're spending a lot of their money instead on travel or dining or entertainment. And so that would also account for why things at FedEx in particular are worse than maybe the whole economy. And this is true throughout the whole stock market. You can look at an airline company and you can say, like, well, high gasoline prices or high fuel prices are cutting into margins. Well, that would be terrible for that particular trucking company or airline company or what have you. But it'd be great if you're an oil and gas exploration and production company. You can see what hurts one company helps another. Or if you're a heavily indebted company, the fact that interest rates are going up means you're going to have to refinance your debt at higher rates, and that's a negative. But if you're a bank or a savings and loan, higher interest rates means you're earning more money on what you have deposited at the bank. So your margins expand and business gets better. And this is just true in so many ways. Take the strong dollar. It's a terrible thing for exporters because U.S. products are more expensively priced in foreign markets, but it's a great thing for importers because imports are more inexpensively priced in our domestic market. So it really doesn't make sense to isolate one stock, no matter what industry they're in, whether it's consumer staples or technology or healthcare or transportation, and then try to draw great conclusions about what lies ahead for the economy and the markets. However, I will say, as I've mentioned here before, that I do think the economic outlook is not nearly as gloomy as the stock market would indicate. Obviously, it's the worst September we've had in 20 years, but wages are up, employment is strong, payrolls are growing. You don't generally have a recession when the economy is adding 450,000 jobs a month. We're finding that consumers are still spending, the fact that even though interest rates are higher. When you look at the stock market, it doesn't necessarily mean that things are going to stay bad. They could get much better, as we've seen some significant rallies along the way, and those could continue. So, in fact, I think that there are three stocks in particular that are very much worth buying. And here's the important thing. They're worth buying no matter what the outcome is of the midterm elections coming up in early November. So I encourage you to click on the link below to read more about these stocks. I think you'll find it very much worth your while. That's it for today. This is Alexander Green at the Oxford Club. Thanks so much for watching.